It's Friday, 21st of March, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the UK Chancellor's spring statement. Will Rachel Reeves raise taxes, cut spending, both or neither? And does fresh political crisis in Turkey mean its asset markets are once again a no-go zone for international investors? But first, Group Chief Economist Neil Shearing joins me to rake through the coals of another week in macro and markets. Hi, Neil.
Hi, David.
Let's start with the March central bank decisions, because we've had the Bank of England and the Fed this past week, Bank of Japan as well. But putting it all together, what's the big message from global central bankers?
I think three major central bank meetings over the past week in advanced economies, the Fed, as you say, the Bank of Japan, the Bank of England, different messages coming from each of those institutions. So if we start with the Fed, the key takeaway is that despite all the risk to inflate, upside risk to inflation from tariffs and so on and so forth, Fed officials are still projecting two 25 basis point rate cuts this year. That is perhaps not a surprise, but it's a different view to ours. We think that rates will be left on hold throughout this year because of the upside risks to inflation posed by tariffs. It will keep the Fed in a slightly more cautious mode. So the Fed officials seemingly taking a slightly different view to us when it comes to the path of rates ahead. In the Bank of Japan, we've been forecasting for a while that there are further rate hikes to come, but the main message from the BOJ meeting over the past week has been one of caution and perhaps concern about the global trade environment. So rather than expecting the next hike to come in May, we now have pushed that back to July's BOJ meeting. So more tightening to come, but perhaps not at May's meeting, coming in instead in July. And then on Thursday, we had the Bank of England meeting. Again, slightly more cautious from the Bank of England, but this time with respect to easing. So fewer members of the MPC voting for rate cuts this week. We had thought there would be one cut every quarter, 125 basis point cut every quarter throughout the course of this year, taking rates to 3.75 by the end of 3.75% by the end of this year. I think it's now perhaps more likely that the MPC skips a cut, either at its May meeting or perhaps more likely its August meeting. So we've only got two 25 basis point cuts in our profile now. That would take UK rates to 4% by the end of this year, but then going down to 3.5% next year as inflation continues to grind lower. I should say we've just published our European Economic Outlook too. This is the kind of major look ahead piece for the next 2 years that we publish once every quarter for all of the world's major economies. In that, we've revised our forecast for the ECB too. So we now project that ECB rates will fall to 2% in this easing cycle rather than the 1.5% that we had thought, before rising to 2.5% by the end of next year as the effects of German fiscal stimulus kick in. So that's all about really these German fiscal reforms, meaning that there's less scope for the ECB to cut rates in the short term and perhaps a bit more pressure on them to hike rates in the back end of 2026.
In all cases, I guess the common theme here is uncertainty, isn't it? Specifically around the Trump administration's policy agenda. How much is that affecting, do you think, the sort of the policy outlook and the faith that central bankers have in their expectations for where rates are going to go?
Yes, I think it's having quite a profound effect, really. If you just look at the actions of central banks over the past few months, they've moved from easing cycles in the case of the Fed, the Bank of England, the ECB. They've either slowed those or paused them, shifted to wait and see mode. And then, as I say, with the Bank of Japan, pushed back expectations for further hikes. So again, shifting to wait and see mode. And I think a lot of that can be linked to uncertainty over the policy outlook. In fact, if you look at what Powell said in his press conference after the past week's FOMC meeting, he basically suggested that they don't have a high degree of confidence in any of their projections or forecasts because of the uncertainty over policy. So I think it's having a substantial influence over the thinking and the actions of central bankers. And really the question then is, when will this get resolved? Everyone's pointing to April the 2nd. We'll get this plan on reciprocal tariffs announced supposedly. The question then is that really going to clear any of this uncertainty up?
Yeah, that's right, isn't it? I mean, as you say, there does seem to be a lot of uncertainty out there around this tariff idea. And one idea I wanted to throw at you is something that surfaced over the last few days. And it's that things will settle down once the reciprocal tariff plan is announced on April 2nd. and that the volatility that we've seen in markets is really sort of the storm before the calm, so to speak. So to what extent do you think things will calm after April 2nd?
It would be nice to think that they might do, not least because it would make recording this podcast slightly easier, wouldn't it? But I don't think they're going to, if I'm being honest. If you look at some of the reporting over the past week on the tariff plan, it does have the faint whiff, doesn't it, of administration officials trying to brief off the record, trying to calm things down a little bit, trying to manage some expectations. There was that story in the Wall Street Journal about the administration potentially considering putting every country into one of three tiers, and that would determine what reciprocal tariffs might look like, and that would, I think, potentially provide some clarity. But then it seems that plan has been shelved, and now they're going on a country by country basis and potentially focusing on the so-called dirty 15 first, the countries with the 15 countries with the largest trade deficits with the US in the first instance. And you're left with this sense that actually what's going to happen on April the 2nd is going to really fire the starting gun for bilateral negotiations around tariffs, starting with those countries that run the largest deficits with the US. And if that's the case, then all it really does is prolong the uncertainty, because we're into this period of discussion, negotiation, horse trading over of tariffs and non-tariff barriers and investment deals. I'm sure it will encompass all manner of different things. And so I think that pours kind of cold water on the idea that come April the 2nd, we'll suddenly have greater clarity over the policy outlook. I think, if anything, it could get even more uncertain.
There's always a tendency to look at the chaos and say that 3D chess is being played here, and there's some big grand strategy that everything's being worked towards. But taking a step back, what is the big game plan here? Is there a game plan that the Trump administration is working to?
This gets you into the weeds of the so-called Mar-a-Lago Accord, doesn't it? That there's been lots of column inches written about it over the last month or so. I set out a bit of a framework for thinking about how such an accord might work from an economic perspective in my notes on Monday this week, and I'm going to revisit some of the ideas that have been put forward in my next note. But it does, you're right, that all of these bits of analysis come from the perspective that there's some grand overarching plan here. And frankly, I don't think there necessarily is, or at least there might be in some parts of the administration. We had that paper, didn't we, by Stephen Mirren, the new chair of the Council of Economic Advisors, that does sketch out a plan. But the idea that Trump has a grand plan for reforming the global trading system and the international financial architecture, I think is a stretch. I think it's more that he's shooting from the hip, and it's much more driven by personalities and a much more transactional approach to trade. So I don't think there is a grand plan, is the honest answer. Doesn't mean to say we might not get attempts at some kind of Mar-a-Lago Accord, as it's been called, to weaken the dollar or reform parts of the global trading system. But the idea that this is a kind of joined up, coordinated approach to reform led from the president down, I don't really buy into, no.
But say what you will, his complaints about US relations with its key trading partners is something he's been going on about since the 1980s. And it does speak to, doesn't it, this idea that there are these imbalances in the global economy that have been carrying on for decades and that do carry risks. So talk a bit about what those imbalances are, and talk about whether any of these various ideas floating around about how to resolve them, coming from within the administration, but perhaps outside as well, whether we are going to get any resolution.
I think you've hit upon the right way to think about it, which is to say, do these imbalances, these trade imbalances matter? And then if they do, what are the policies that might help to alleviate them? Now, on the first question, do they matter? I mean, the short answer is yes, although not necessarily for the reason that Trump himself has suggested. The fact that the US runs a trade deficit has nothing to do with the decline of manufacturing output, I don't think, in the US. And it doesn't reflect the fact that other countries are, quote unquote, taking advantage of the US. If anything, actually, the fact that other countries are willing to lend to the US and allow the US to consume more than it produces, which is essentially what the trade deficit represents, means that other countries are being beneficial, advantageous to America. Why do the deficits matter? It's because of that financing of them, and it requires America to take on ever greater amounts of external liabilities in order to finance these deficits. And the accumulation of external liabilities by the US leads to this buildup of vulnerabilities in the global financial system, not least because the dollar sits at the center of the global financial system. The flip side of the US deficit, of course, is that China and other economies are running large surpluses. And in China's case in particular, that is symptomatic of weakness of consumer spending, and that's playing into the weakness of economic growth in China that we've written lots about and discussed lots about on this podcast too. Imbalances matter, but not necessarily for the reason that Trump thinks. The question then is, how do you deal with them? And lots of measures have been put forward and ideas have been put forward, but to my mind, the key really is to rebalance expenditure within the world's two major economies, the US and China. At the moment, domestic demand in the US is too hot and domestic demand in China is too weak. So this is about savings and investment behavior within America and China. So the way you address this is you have some grand bargain where China agrees to reflate its domestic economy, unleash consumer spending, direct more income to households, get its savings rate down. That gets its trade surplus down. That sucks in more imports from other parts of the world, potentially from the US, which then allows the US to get on with tightening fiscal policy, narrowing the budget deficit, which in turn should squeeze domestic demand and narrow the current account deficit. And you alleviate trade imbalances by rebalancing expenditure within particularly the US and China. That's the most effective and pain-free way, I think, of addressing these imbalances. It just isn't going to happen. I mean, the idea that there's going to be some coordinated agreement where the US agrees to squeeze fiscal policy and China agrees to reinvigorate consumer spending, it runs into several problems. Not least, it runs counter, I think, to the economic thinking that's prevailing in Beijing. But also, of course, you have this idea of US-China rivalry and superpower rivalry. Each side needs to give something, and will they be willing to give that? So I don't think that's necessarily going to happen. So then you get into what economists might call expenditure switching policies, currency revaluation, currency realignment. Tariffs is one idea. It falls into this bucket too. And I think they're going to be less effective, is the short answer. The key component of this is tariffs. We've poured cold water on the idea that tariffs are an effective tool to rebalance global trade. Another idea is to have a coordinated devaluation of the dollar, which might help, I think, at the margin, but only is likely to be most effective if you get these measures alongside it to put the US trade position on a more sustainable basis going forward, including fiscal tightening too, which I don't think is necessarily in the offing. Yes, trade imbalances matter. There are policies out there that I think can redress them, but they require coordination. They require expenditures to be rebalanced within the world's two major economies, the US and China. They require a shift in savings and investment behavior in those economies. And unless or until we get that, then I think everything else is going to really only not make much of a difference, frankly.
And wherever we get to, you're not going to be having cars made entirely within the borders of the United States, and you're not going to have American factories churning out iPads, and you're not going to bring all that manufacturing back to the US, presumably.
I think that's probably true. I think it's possible that in some strategic areas, you do get some reshoring of production to the US. I think we'll see more production of semiconductors in the US over time. I think the US is going to curb its imports of semiconductors quickly, but over time, I think it will build out domestic capacity. I think industries such as steel, clearly Trump views that as having some degree of self-sufficiency or greater domestic capacity as important. That could be an area that it has greater focus, maybe some vehicle production, but again, that might be more likely to be done within the confines of North America rather than the US itself, this idea of fortress North America that Scott Bessent, the US Treasury Secretary, has talked about. So I think there will be some shifts in the production of some goods back to the US and potentially back to North America. But I don't think there's going to be substantial and significant shifts, particularly once you start to get to goods at the kind of lower end of the value chain. The economics don't make sense there. So yes, some shifts in the production of strategic goods and potentially high-end goods, but for most production, no, I don't think we're going to see that moving back to the US in large quantities anytime soon.
So you talk about this superpower rivalry between the US and China. I mean, how much of this is these imbalances are the byproduct of the US as the dominant economy in the world? That you often talk about the exorbitant privilege of the US as the issuer of the dollar. But that exorbitant privilege comes with costs, and the costs are that it has to run these deficits in order to supply the world with treasuries.
Yes, and this touches upon an argument that gets economists going, which is to say, does the current account of the balance of payments lead the capital account of the balance of payments, or does the capital account of the balance of payments lead the current account balance of the payments. And if all of that sounds rather arcane, it gives you a sense of what gets economists going. But it's important in the context of the current debate. And there are some analysts, and I've got some sympathy for this idea actually, that would argue that it's because the dollar's role as the key currency within the global financial system that exacerbates some of these imbalances, because it creates demand for dollar-denominated assets. That creates capital inflows to the US, that pushes up the value of the dollar, makes it stronger than it otherwise would be. And because the dollar appreciates, that makes US exporters less competitive than they otherwise would be. And that, of course, then weighs on the trade position. So I think there's something to this idea that the dollar's central position within the global financial system has exacerbated some of the trade imbalances. But I wouldn't overdo it. For a start, the value of the dollar's ebbed and flowed over the last 20 or 30 years. The dollar's been the dominant currency within the global economy for the last 50, 60, 70 years, really. And the US current account positions fluctuated over that period too. Clearly, the fact that the dollar has been central to the global financial system, and that's inflated demand for dollar-denominated assets, there's no direct link to the US current account position in that sense. And what's more, even if you were to then push back on capital inflows to the US, that would have costs too. I alluded to this at the start, which is that President Trump might view the US current account deficit or trade deficit as other countries taking advantage of America. I think it's perhaps more accurate to view it the other way around, which is that it reflects the willingness of other countries to lend to America because of this demand for dollar-based assets. And that allows Americans to consume more than they otherwise produce. So if you squeeze those capital inflows, then for an economy at full employment, you have to squeeze consumption elsewhere. And that means pain ultimately for American consumers. So in that sense, I think the administration should be a bit careful about what they wish for.
Neil Shearing there on global imbalances and why a Mar-a-Lago Accord isn't the fix-all that's being pitched. He mentioned his upcoming note. I will add that to the podcast notes as soon as it's out on Monday. I'll also add our latest Europe outlook, which Neil mentioned with those new forecasts. The Economist held a drop-in, that's one of our short-form online briefings, just after the Bank of England meeting on Thursday to talk Fed, ECB and Bank of England. I'll add that to the podcast notes as well for good measure. Now, this is being recorded midday Friday UK time, just after the release of some pretty grim public finance figures. It's a painful reminder of how little room for manoeuvre the UK Chancellor has. Rachel Reeves is due to give her spring statement in the House of Commons this coming Wednesday, and I spoke to Ruth Gregory, our Deputy Chief UK Economist, about what to expect. I started by asking her how the UK fiscal landscape has shifted since Reeves' debut budget statement back in October.
Well, in the October budget, the Chancellor left herself a margin or fiscal headroom in the jargon of just 9.9 billion. Now, that might sound a lot, but it's very small in the context of the 2.7 trillion economy, the fact that the government spends around 1.3 trillion, and it's less than half the headroom that chancellors have had against their fiscal rules at fiscal events since 2010. So the Chancellor hasn't made things easy for herself. In October, she introduced a point target fiscal rule and left herself the slimmest of margins against it. And since then, I think there's been three key economic developments that have really changed the fiscal picture. The first is the rise in market interest rate expectations and gilt yields since October, which has increased the government's borrowing costs. The second development is the latest figures, which suggests that the economy is all but stagnating, and that's weighing on the government's tax revenues. And of course, we're not expecting the economy to grow much in the coming quarters as businesses adjust to higher taxes, and the deteriorating global backdrop holds the UK economy back this year. And the third development is that inflation has remained pretty sticky, which increases the government's interest payments on things like index-linked gilts and raises spending on benefits. So all this means that without any policy changes, the Chancellor is on course to break her main fiscal rule, perhaps by a slim margin of around 1.6 billion.
So fiscal rule broken by 1.6 billion, as you suggest, not a huge amount in the grand scheme. So going into Wednesday, her statement was set up to be a non-event, right? That it would just get updated OBR forecasts, a quick bringing up to speed by the Chancellor. With all that you said, What are we going to hear on Wednesday? Are we just going to get that update, or is it going to be something more substantive?
I think to avoid breaking her fiscal rules and to rebuild her cushion, it's likely that the Chancellor will announce some spending reductions, perhaps rather than tax increases. After all, the widespread plunge in sentiment following the employer national insurance contribution increase that was announced in the October budget, we doubt the Chancellor will want to hit sentiment further and exacerbate the further weakness of the economy by raising taxes. And trimming spending is the approach the Chancellor has taken so far when grappling with the need to ramp up the UK's defence capabilities. We know that the government's seeking to make $5 billion of savings by cutting the welfare budget, and we think she will probably use her statement on Wednesday to unveil a bigger squeeze on non-defence spending from 2026 onwards.
Given all of these variables in terms of what's happening with the economy and with borrowing costs and with this global environment, how far are spending cuts going to get us? Are we going to get to the point where Rachel Reeves has to break her read my lips, no new taxes pledge? Maybe not this statement, but perhaps come autumn, because it doesn't sound as though certainly the economic outlook is going to brighten much. It doesn't sound like the international environment is going to brighten much. It doesn't sound like spending demands are actually going to reduce in that time.
Yeah, I suppose more important than what she announces on Wednesday is how the Chancellor deals with the growing pressure to increase spending, particularly defence spending. So far, the Chancellor's announced an increase in defence spending from 2.3% of GDP to 2.5% of GDP by 2027 by cutting spending elsewhere. But I think there's a limit to how much other spending can be trimmed to accommodate higher defence spending, especially as the government has promised to protect large swathes of spending, including things like the NHS, defence and schools. And that means that unprotected areas are already facing quite large, actually, real-term spending cuts. So I think the reality is that even if the Chancellor tweaks the fiscal rules to allow the government to spend more on defence, unlike in Germany, for example, the UK's poor fiscal arithmetic means that it probably has much less space to increase borrowing. So I think there is a limit to how far borrowing can rise in the UK and how much other spending can be trimmed. And that means that if defence spending is to rise above 2.5% of GDP, perhaps to 3.5%, which would broadly match the US's expenditure or Germany's commitment, then I think this is likely to be at least partially funded by higher taxes.
You mentioned there what's happened in Germany. They basically abandoned this debt brake, the self-imposed constraint on fiscal spending. And only a few weeks ago, that would have been considered unthinkable. But that was the old world, and now we're in a new world. And in this new world, how fit for purpose is this whole biannual exercise of fiscal rule setting and it all happening in the shadow of these OBR watchdogs? Is there a case here for reviewing the whole UK fiscal framework in light of the fact that we are looking at much, much bigger demands on spending?
I think we'd probably caution against getting too fixated on the specifics of the fiscal rules. As you say, it's perfectly possible the Chancellor will tweak the fiscal rules at future fiscal events, as countless other Chancellors have done when it suited their cause in the past, perhaps to provide a carve-out for defence spending. I think ultimately what matters more to investors is not the fiscal rules per se, but the feel and the attitude that the government has to the fiscal situation, as well as the mathematics and the dynamics around public debt. And I think the problem at the moment is that as things stand against the current backdrop of low growth and high interest rates, the key point is that the government really has to demonstrate that it is fiscally prudent and that it plans to take decisive action to stabilise and eventually reduce the debt to GDP ratio, regardless of the specifics of the fiscal rules. I think fiscal rules are a political tool to convince the public and the markets that you're credible. I don't think the markets necessarily care about the rule per se. I think it's more about the general feel of the overall framework. So you could have no fiscal rules or loose fiscal rules, but a government that displays an attitude and action that the bond markets like. Or you can have fairly tight fiscal rules and a government that the markets view as reckless. I think it's the feel of the fiscal framework as a whole that matters.
That was Ruth Gregory on the UK's evolving fiscal picture. Our UK team will be online this Wednesday just after the statement to answer your questions in a drop-in. Details in the podcast notes. I'll also add a link to our new UK employment indicator. It's been released in response to well-documented problems with ONS labour force survey data and gives you a clear view of how employment growth is developing in the UK in the absence of a reliable official read. It's just the latest in our growing range of data tools that are being rolled out for subscribers to CE Essential and CE Advanced. These are our all-access packages, and they are designed to give you the fullest picture of what's happening in global macro and markets, along with a host of ways to engage directly with the Economist team. Speak to your account manager to find out how these packages can start helping you today. Finally this week, Turkey's been plunged back into crisis mode and its financial markets hammered after the stunning arrest of Ekrem İmamoğlu, the Istanbul mayor and rival to President Erdogan. Liam Peach, our senior EM economist, has been following developments closely, and I caught up with him on Thursday to ask whether this turmoil in Turkish markets marks an end to the country's only recent re-embrace of policy orthodoxy.
I think it goes without saying, really, that an erosion of institutional quality like we've seen in Turkey this week is a major concern, not just for any emerging market dependent on capital inflows, but particularly an economy like Turkey with a turbulent history of political instability following the coup attempt in 2016, and a country like Turkey with large and existing financial vulnerabilities. The main question, I think, really is about whether this is a threat from a macro market perspective to the broader shift towards policy orthodoxy underway. I don't think it is, but I certainly think the risks have probably increased. So what we've seen this week, we've seen large foreign currency intervention from the central bank to try to limit the extent of currency depreciation. On Thursday, the central bank responded with an interest rate hike to the upper level of its interest rate corridor. It didn't hike its main interest rate, but it hiked the upper level by 200 basis points. I think this is really a decision by the central bank to try to manage a lot of the short-term volatility that's taken place in Turkey's financial markets. I think it may raise questions about the use of the interest rate corridor in Turkey, which has been an issue in the past, and it's been something that the central bank has tried to do to pull the wool over President Erdogan's eyes, and that's led to an erosion of its credibility. But this does look a little bit more genuine. The communications were fairly hawkish. The central bank set out a pledge that it could tighten the monetary policy stance if there is a threat to the inflation outlook. So overall, I think the way this has played out in markets and the way the Turkish central bank has responded, I think has probably given investors and analysts a lot of confidence that this shift to orthodoxy that we've seen over the past year and a half is not under threat from the political turmoil that's taking place at the moment.
Let's talk a bit more about the CBRT because their easing cycle is less than 3 months old. You mentioned there about inflation risks. What happens now in terms of inflation risk, given what we've seen with the currency, and how do we see policy evolving from here? But also an additional central bank question. Is there a risk that we go back to that old revolving door of central bankers who fall foul of the president?
Yeah, so I think that the immediate reaction really in financial markets has been a big spike in Turkish local currency bond yields. A lot of monetary easing that was priced in for this year has now been taken out. The last time I checked, the 2-year local currency bond yield in Turkey was up more than 500 basis points. I think there was a question really about whether they would be able to cut interest rates at the next meeting in April. I think that it's almost out of the question now. Really, the question is about whether they will be forced to hike again. And I think a lot really depends on the extent of exchange rate moves that we're going to see over the coming days and weeks. We're looking at a Turkish lira that's down 3-4% against the dollar since the open on Wednesday morning. I think if we were to see further falls like that in a perhaps disorderly manner over the coming week, then that would move the needle in terms of the inflation outlook, and we probably would see the central bank respond. How they respond, I think, really depends on whether they consider this to be something more lasting or something more short-term in nature. It's possible they raise the upper band of the interest rate corridor again because they want a little bit more flexibility in tightening monetary conditions in response to market moves. If they were to use those policy levers for too long, I think we'd be a little bit more concerned about maybe the central bank isn't responding in the credible way that many had hoped. But I think the way the central bank has communicated, we could be talking about an outright interest rate hike within the next month if we were to see much larger currency depreciation coming through. I think really there was perhaps a little bit too much optimism priced into Turkey's markets before these events have taken place. We were looking at various measures, including Turkey's risk premia, the spread of Turkey's sovereign dollar bonds over US treasuries had reached multi-year lows. Currency volatility was very low. It had looked like Turkey was sensitive to some bad news, and maybe the pace of, or the extent of easing that was priced into Turkey's markets by the year end was probably a little bit too much given the ongoing strength of inflation. So I think we've seen a bit of a reassessment of that now. Certainly, we think the central bank will be in a position to cut interest rates further, but I think at least in the short term, pressure we're seeing on the currency could cause a change in their plans as soon as the meeting in April.
So much depends on these macro and market variables, but much also surely depends on the politics as well. You held a drop-in yesterday, briefing clients shortly after that this news broke. And someone on that raised the point about separating out the political from the economic. But also we've seen this movie before, haven't we, where Turkish asset prices plunge after a surprise from Ankara, a dents investor confidence. So how can we be sure that investors are going to stay engaged while Erdogan undermines democracy, even if the central bank is doing everything it should be doing to respond to shifts in the macro market picture?
I think fundamentally we should be careful about reading across from what is a political event to economic policy. I think the way the policymakers in Turkey have responded to these financial market developments has given us confidence that Erdogan isn't going to fundamentally change this reform agenda underway. We've seen some encouraging signs from Finance Minister Şimşek. We've seen the central bank coming out with some fairly hawkish comments. Overall, I think these are two independent events, but of course it does raise questions about if Erdogan is feeling under pressure politically, then he could use economic policy as a way to support his political position. So that's something that I think we need to be careful with. One thing that had given us confidence was that Turkey generally has a fairly light election calendar. So it hadn't looked like there was going to be the potential for big political disruption over the coming years that could really cause this policy shift to unravel. I think that assumption maybe now is being questioned slightly. But I think we probably need to see how far the government's actions go and how much of an erosion of democracy that we do see in Turkey, how that feeds through into foreign investor capital inflows into the country, and how the central bank might respond. From a purely macroeconomic basis, Turkey's fundamentals, we think, are looking quite good right now. There's been a really big improvement in a lot of metrics that we're tracking on external position, the balance of payments, foreign exchange reserves. Turkey's economy is in a better position to be weathering some of this political risk and political turmoil than it has been in the past. And the central bank is in a much better position to be responding to. Its foreign exchange reserves are higher. It has a higher real interest rate. All of this, I think, should at least provide Turkey with some stability in the face of political instability. But I think we need to keep monitoring how the rule of law in Turkey is developing, the erosion of checks and balances, the attacks that are taking place against the opposition parties in Turkey, and how foreign investors and broader policymaking environment responds to that. But at this point, we're still holding a fairly optimistic view on Turkey's medium-term macro outlook. We think this policy shift will continue, but we can't keep our head in the sand. We need to be alert to these risks and how they're developing.
Liam Peach on a fresh crisis in Turkey. As Liam says, the team are tracking developments closely and updating clients on the associated risks. Our EM financial risk indicators, which are available to CE Essential and CE Advanced clients, show how Turkish FX, bank and sovereign risks look within the context of the EM universe. And I'll add a link to the dashboard of those indicators as well as to Liam's latest note on Turkey to the podcast notes. But that's it for this week. We will be back next week with more on the Trump trade agenda ahead of that April 2nd release of the reciprocal tariff plan, and much, much more from the front lines of global macro and markets. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.